Welcome to the Retirement Guide Podcast. I'm your host, George Jameson, owner of Capital Wealth Group, a flat fee only advisory firm. Whether you're nearing retirement or already retired, join me each week as we explore the world of retirement planning and equip you with the knowledge and tools you need for a successful retirement. So let's get started. Today we're diving into the world of dividend stock investing. First off, what exactly are dividends? Well, dividends represent a portion of a company's profits that it chooses to distribute to its shareholders. Many investors prefer dividend stocks because they often appear less risky than the broader stock market. By holding shares in established, well-known companies, you can generate passive income. If you're nearing retirement or already retired, dividend stocks may seem like an appealing long-term investment. Again, they offer you the option to reinvest or use the dividend as retirement income. But the question is this truly a safer approach to investing? In my opinion, and from all the research that I have done, it may be less risky, but it's not a given. So let's explore this question in more detail. We all know the pros, so let's look at several cons to consider before putting your hard-earned retirement savings into individual dividend stocks. First, they are still individual stocks, like any other. And that means there's inherent stock risk. You could potentially lose some, all, or a substantial part of your investment. And second, by paying out all the cash and dividends, the value of the company is reduced by the amount it paid out. Third, dividends reduce what the company can reinvest for growth. And fourth, if you reinvest the dividend in a taxable account, dividends are effectively forced taxation. And fifth, if you're a retiree, depending on that dividend payment, exposure to a dozen individual stocks for passive income can be risky. And sixth, please note, dividend stocks are not substitutes for bonds. However, for the right long-term investor, owning a portfolio of low volatility, dividend-paying stocks of well-established companies may make sense. But you have to be aware of individual stock risk, possible sector risk, and from time to time, some of the stocks you own will take a substantial drawdown unrelated to the overall stock market, and at times may drop further than the broader market. So two key ways to measure dividend stocks are the dividend annual yield and the dividend payout ratio. The dividend annual yield is calculated by dividing the dividend per share by the stock price per share. Dividend stocks can range from annual yields of less than 1% up to nearly 10%. Be cautious when considering stocks with excessively high dividends. The dividend payout ratio is also important. It represents the percentage of a company's earnings that are paid as dividends to shareholders. A healthy dividend payout ratio typically falls between 30 and 50%. Anything over 50% could be unsustainable. And here are some other important ratios to consider when investing in individual dividend stocks. They are the dividend coverage ratio, the free cash flow to equity, and the net debt to EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And just because a company offers a dividend today doesn't mean their stock price can't plummet or they won't cut their dividend, or both. Look at the recent poor performance of these four well-known dividend stocks over the past 2 to 5 years. They include Disney, Verizon, AT&T, Target, and Dominion Energy, just to name a few. According to Morningstar, Disney is down about negative 51% over the past 2 years and stopped paying dividends after December of 2019. Verizon and AT&T are still paying dividends, but Verizon is down about negative 20% and AT&T is down about negative 22% over the past 5 years, including dividends. Target is down about negative 47% over the past 2 years, including dividends. And Dominion Energy is down about negative 16% over the same 5-year time period. versus XLU utility ETF, which is up about 39%, and both are including dividends. But my point is just to show you that most stocks from time to time will have dramatic drawdowns, and when you only own 20 or so stocks, it could have a substantial effect on your overall portfolio. Personally, I prefer peace of mind knowing I don't have to worry about individual company performance, only the overall market, or a portion of a market's performance if you are trying to reduce volatility. I've noticed that for many nearing or in retirement with substantial investable assets, their main objective is to minimize risk and volatility without a specific focus on keeping up with the overall stock market. They're really more concerned with reducing downside risk. And let's put asset allocation aside for now and just discuss the stock portion of your portfolio. And that's why I'm seeing more and more people choose to either buy individual dividend stocks or hire an advisor who builds a portfolio of individual dividend stocks, thinking this is a more conservative way to invest in stocks than just owning the total market. This may be true, but it's not always the case. The issue is that owning a couple dozen dividend-paying stocks doesn't necessarily mean their portfolio is less volatile or risky, and they may actually be taking on more risk depending on the stocks they own. Successfully investing in individual stocks is very challenging, which is why I generally suggest looking at ETFs when building your portfolio instead of individual stocks. ETFs typically own at least 50 and often 100 or more companies in each fund, which makes it much easier to reduce or eliminate individual stock risk, which is the only free lunch in investing. With the development of hundreds of exchange-traded funds, investors and financial advisors now have the opportunity to construct portfolios that align with their goals and preferences, all while maintaining a degree of diversification compared to holding just a couple dozen individual stocks. And the best part, a lot of these ETFs come with very low expense ratios. So if you aim to reduce equity volatility and eliminate individual stock risk, investing in a mix of low volatility and dividend equity ETFs may make sense. You have specific low volatility and specific dividend stock ETFs, as well as sector-only ETFs that may make sense for a part of your overall stock allocation. The three main defensive sectors, historically speaking, are consumer staples, utilities, and healthcare. But it's important to note that cherry-picking specific sectors and being too overweight in any one sector can add risk to your overall portfolio. Per a Morningstar article, Are Dividend Stocks a Good Investment Today? By David Harrell and Susan Zubinsky. As to whether or not dividends are defensive in practice, it depends. Amy Arnott, who's a portfolio strategist for Morningstar, recently looked at 6 recessionary periods going back to 1980. And what she found was that in 3 of those periods, dividend stocks outperformed the broad market. And in 3, the broad market outperformed dividend stocks. So yes, you think of them as defensive, but not necessarily, at least not in all recessionary environments. So in conclusion, when it comes to reducing overall investment risk, a historically effective approach has been owning the entire stock market through low-cost ETFs and adjusting your asset allocation, particularly by increasing your allocation to government bonds. However, it's important to acknowledge that not everyone feels comfortable holding the entire stock market, even when combined with bonds. For those considering individual dividend stocks, it may be worth exploring low volatility and dividend ETFs as an alternative or in addition. These ETFs include stocks that tend to have lower volatility over the long term while still offering diversification. But it's crucial to exercise caution when chasing high yields, whether individual stocks or ETFs. Always conduct thorough research, regardless of the path you choose. Ultimately, trying to select individual stocks, even for professionals, can be a challenging endeavor. As Warren Buffett argues, a portfolio comprised of low-cost index funds is often the wiser choice. It's especially important for retirees who often seek to minimize their overall market risk. Whether you opt for low volatility and dividend ETFs or a portfolio of dividend stocks, they may lower overall risk, though they may underperform the broader market. Always remember, past performance is not a guarantee of future returns, and maintaining a diversified portfolio is important. Adjusting your asset allocation, especially by increasing your bond allocation, can be an effective strategy to mitigate risk. However, for those inclined to take a more conservative approach and who are less concerned about keeping up with the total market, maintaining a defensive portfolio with low volatility and dividend ETFs may also be a valuable option, offering a balance between risk reduction and long-term returns. That wraps up today's episode. Hope everyone has a great day. Thank you for tuning in to this episode of The Retirement Guide. If you enjoyed this episode, please subscribe and leave a 5-star review to help others discover the show. For questions, ideas, or discuss your retirement plan, reach out to me, George Jameson, at Capital Wealth Group. Visit our website at capitalwealthplan.com to learn more. Thank you for listening. Stay tuned for more insightful retirement planning in future episodes. And now for the disclaimer. The information discussed in this podcast is for general explanations and education only. It is not tax, legal, or investment advice. Before considering acting on any information heard here, first consult with your tax, legal, or investment advisor. Thank you and have a great day.